Hi, it's that time of the year again when we turn our attention to year-end tax planning. Some ideas of what we should look at and plan for 2014 and to make sure that we get the most out of our tax refunds in 2013. So first, let's start by looking at some items that would be of interest to individuals. I'd like you to be sure to maximize your TFSA and RSP contributions. Obviously, you've got until the end of February to do that for the RSP contributions, but turn your attention to it now because it's something you don't want to miss if you've got the flash cash flow to cover it. I'd also like you to review your portfolios to consider matching capital losses with capital gains already triggered this year. We call this tax loss selling, and it has to be accomplished before the end of business of December 2013 to apply. Another way to do the same thing is you may want to consider triggering capital gains this year to harvest any net capital losses you have from prior years. You could also do it in reverse. You may want to trigger capital losses this year to carry back as far as 3 years for any tax return where you reported net capital gains. When it relates to donations, we have a break point in donations per our tax return of $200. We get approximately double the tax credit from 20 to 40% if we contribute over $200 a year. Therefore, I'd like you to consider, if you can't make major contributions every year as most can't, that maybe you double up once every 2 years and provide your maximum contributions to get the most out of this excess contribution. So obviously, $400 every 2 years is better than $200 once every year. Also, you may want to consider donating in-kind securities or insurance policies or other tangible properties. If you need additional information on this, please look back into our Tax Alpha catalog where we did a complete series on in-kind donations. 2013 is the year that you must be prepared to report details of foreign properties on your personal tax returns on a Form 1135. This is CRA's attempt to start to track down not reported assets and income around the world for Canadian citizens. Their threshold is now $100,000, and this does not include a pure recreational property that you might have someplace south, nor does it include any foreign investments held in Canadian domiciled investment accounts managed out of the Canadian investment world. I'd like you to review your portfolio asset allocation mix to make sure you have it right now for 2014. This would be especially true if you're proceeding towards retirement. You may want to make your portfolio more conservative. And specifically for senior investors, be sure to utilize the annual $2,000 pension tax credit each year, remembering that OAS and CPP do not qualify. You must have RIF payments that total $2,000 or more to get this credit, or a private pension. You may also want to look at whether you're eligible to withdraw any RSP funds before the end of the year, and you would only consider doing that if your tax rate to withdraw was lower than the tax benefit you received when you made the contribution. This will lower the minimums that you will eventually have to take out of your RSP and make it more likely that you'll keep your old age security later in life. Also like you to be sure to utilize the pension split between you and your spouse at the end of the year on your personal tax return. This allows us to split RIF and pension income and dramatically lower net income for each individual, also reduce taxes as a family, and make it less likely that we'll be clawed back on our old age security and other things that are based on net income. This is not an exhaustive list. It is very important that you meet with your accountant and financial planners as soon as you possibly can to get this right for 2013, going off into 2014. Hope that gave you something to think about, and we'll see you the next time on Tax Alpha.